With rising carbon emissions threatening the Earth's climate, multiple solutions have been proposed to deal with this predicament. A potential one is emissions trading systems, or carbon markets, which has already been experimented by the EU. And there are already 64 carbon pricing instruments in the world, generating $53 billion in revenue from last year. But now China, one of the world's fastest growing and biggest economies, is implementing their own emissions trading system on a national scale. This is ambitious and unprecedented, as this is the largest emissions trading system covering 2,225 coal and gas plants as well as 4 billion in carbon emissions. This may be necessary, considering that China makes up 30% of world emissions, but how does an emissions trading system work? The system/carbon market involves the use of trading permits for businesses emitting carbon dioxide. These trading permits are used within a certain specified period where a limit is placed on carbon dioxide emissions produced. At the start of each period, all companies who want to emit carbon emissions will buy these trading permits, where each trading permit will allow the company to emit, say, 1 ton of carbon. If one company emits less carbon than is allowed at the end of a period, then they cash those permits in and gain money, or save those permits for the next period and emit more than what would have been allowed. If another company emitted more than what was allowed in the same period, then they would have to buy those permits from other companies, or pay a fine to the government at the end of the period. This allows for emissions to be cut where it costs the least to do so. I have actually analysed the EU emissions trading system in a previous video, so please feel free to check it out. Starting by the end of June, it has been predicted that China could gain strong pricing power provided that carbon becomes a new currency. This is because a limit placed on carbon emissions will make carbon trading permits more valuable, as a lower available supply of a good increases the price of said good. This, combined with China's large economy, will increase their bargaining power with the rest of the world if they are also regulated by carbon markets. China may also be able to take advantage of a supposed climate boom, not only due to carbon markets, but also due to their role in green finance and green technology. Goldman Sachs has estimated there is a $16 trillion opportunity for China's net zero ventures, including 40 million new jobs by 2060. China can enhance its pricing power by incentivizing domestic businesses to lower emissions to increase their share in global emissions trading, and eventually open up and connect to other international carbon markets. Chinese financial institutions can respond to the carbon markets by coming up with new businesses like carbon financial derivatives and emission quota repurchases. Of course, it will take time to connect with other carbon markets like Japan or South Korea, so this must be done gradually. The price of the Chinese carbon permits are actually much lower than the EU ones, which I will get back to later. The Chinese carbon market has a bright future, with Citi forecasting that it will expand by 30 times in the next 10 years. For now, it will only be applied to the power industry, which is a third of Chinese emissions, but will be expanded to other sectors like steel, cement, and petrochemicals. Other Citi predictions include allowable emissions to increase from 200 million tons to 1 billion tons by 2030, and $4 per ton to $25 per ton. But Bloomberg reports that if policies are stringent enough, this could precipitate the shifting of supply chains of emission-intensive industries from China to other countries that do not face the same regulatory costs. This basically means that since the carbon markets increase production costs for businesses, they may move to other countries with no carbon markets, since they have relatively less costs. Now, China actually had pre-existing carbon markets in different regions to experiment with the concept, but some sources say the number is 7, while others say it is 8. Regardless, most sources say there are 8 Chinese regions that have carbon markets, so I'll go with that number. And these 8 regional carbon markets that include Shanghai and Beijing will be integrated to China's national carbon market. However, there are some blockades to the emission system. The penalties and cost of permits is low because China wants to accurately record their past emissions, and also don't want to invest too much money into it or cut output if other innovations like carbon capture come cheaper, which takes the purpose out of carbon markets. The lower price of the permits below verified emissions has also been a problem for the EU, which I highlighted in the EU video. There are also concerns that data is misreported due to errors and skewed incentives to report higher GDP and other economic metrics, which may lead to under or over-reporting. But there has been a narrowing of reported and actual emissions due to lower errors, and the use of third and fourth parties has been used to counter the skewed incentives. Well, as of this recording, I may hopefully appear in 2 streams. one on Mikhail's channel, and another on Toasted's channel tomorrow that will start somewhere from 1 to 1:30 PM Eastern Time, so please feel free to check their channel links below, and also sources in the description as always. Anyways, I hope you enjoyed this video. If you did, please give a like and comment, as it really helps my video in the YouTube algorithm, and if you like economics and political commentary, consider subscribing. Maybe follow me on my Twitter, and see you later.